18th, Thursday. And I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I got out of snap and pins into the up move today. I got into JP Morgan. I put on some TQQQ as a hedge. Might be a little premature. I might have started it too early, but we can take a look at those charts. Everything else I think is the same. Crazy day. This market is so crazy. Completely nuts. Big up day today. SPY's up 1% and 3/4. The NASDAQ is up 2.5%, and the Russell 2000 is up 1.5%. We still have a lot of relative strength, not just on the daily chart, but even on an intraday basis, in the NASDAQ versus the Russell. Again, NASDAQ up 2.5%. IWM up about 1.5%. The contrast, and this has been one of the things that I keep talking about recently, the contrast between the Russell 2000, which represents your kind of average stock out there, your average mid-cap and small-cap company, versus the Qs, which is heavily dominated by Apple, Google, Amazon, those mega-cap companies. The difference is huge. And it actually made, I thought this morning, more difficult to analyze. I came in today with less conviction than I have the last few days. Still a bullish lean, so I guess the fact that the market's up a couple percent and I had a bullish lean still worked out for me. But I certainly was not as aggressive today as I had been in some of the previous trading sessions. And yeah, I mean, I'm just blown actually by the degree of strength. But coming into today, you know, we're looking at these mixed signals on the daily chart, right? We had the SPYs, which were still slightly extended to the downside, but not so much that you felt like you had a real advantage. They almost seemed kind of neutral, getting close to our 393 resistance that we were looking at, which is where we broke down from with the whole banking crisis and everything that's occurred starting on March 9th into March 10th. So we recaptured that really important support level that got lost for the SPYs today. But this morning, we didn't know that was going to happen. And the market was below that potential resistance with not a lot of room to it. So SPYs I thought were a little bit more neutral, whereas the Russell, the low of the day today in the IWM, I mean, what a sick range. Low of the day in the IWM is 170.50, ADMA is at 178.50. We had $8 of downside in the Russell. That's still that extreme downside extension resulting from the sell-off where you want to go counter trend. So IWM, SPYs are telling me, I don't know, flip a coin. IWM is telling me, hey, you should probably do some buying. And Qs this morning were strong, but it's like kind of day 4 almost, and we're almost beginning to get a little bit extended to the upside. Though I guess I could make the argument that the relative strength in the Qs puts that in the bullish camp as well. And then if you combine that with the fact that our short-term tactical, even after closing decently well yesterday, was still in this green zone, which for me does not necessarily mean buy. It means don't short and maybe buy. That was kind of an added layer of probability there. I thought that Bill K's 0 DTE was a little bit conducive for bulls, at least in a small way, to a certain point today as well that we were looking at. So I guess I was, didn't have the same conviction level this morning, but was still cautiously optimistic that we could catch a bid further, that this IWM could play catch up. But what I really kind of want to see in this up move is actually not what happened. If we were going to move up the way that we did today, I would have really rather the IWM outperform and play some catch-up, play a little bit of mean reversion. That was one of the things I talked about in the morning meeting today was, maybe our Qs can show a little bit of relative weakness, hang out up here in this $300 area, which is acting as some resistance, while our mid-caps, our small caps, our banks can bounce back a little bit to catch up from that relative weakness. And we ended up just seeing a very broad-based rally across the board with tech leading, mega cap tech leading, which, you know, we were looking for mega cap tech to lead on Monday. That was one of the first things I pointed to when we were, you know, concerned about the banking crisis with SVB and everything that was going on. And I was like, well, just look at Apple's balance sheet. I don't think you got to be too worried about Apple. That could be a flight to safety. But, you know, here we are on Thursday of this week, and some of those banking fears are maybe beginning to abate a little bit. Maybe not for some of the regionals, but maybe a little bit more broad-based when we're talking about the major banks that are out there. I would have liked that to have led to some outperformance in the IWM, which did not actually occur. And now here we are at the end of the day to continue our weirdness for this market. Here we are at the end of the day with the Qs, $9 extended. The Q is very similar to the SPYs. When we get $10 plus away from the ADMA on the daily chart, it tends to become very difficult for continuation. So we got the Qs here working towards that $10 worth of extension, and the IWM is still not even back to equilibrium yet. Has still not even fully bounced back to the ADMA. It's just really wild. And you know, if my thought process had played out, it didn't, where the Qs rested a little bit more today and the IWM played some catch up. I kind of think that would actually be healthier, because then you'd be looking at a NASDAQ that's still strong but not super extended, the IWM that's getting back into that equilibrium zone, and then we can kind of, you know, take it from there. But instead now I'm looking at, you know, Qs that are starting to get overly extended to the upside, with an IWM that had a pretty good bounce back but still isn't even all the way up to the ADMA. So it's a really tricky market. It's like a tale of different markets. It's almost like, depending on what you type up, you're looking at like a completely different universe. And then to add on to that, as far as mega cap tech goes, was the option flow today. The option flow in mega cap tech was as intense as I can remember, at least especially for recent memory. There was so much bullish option flow. Amazon, Google, Microsoft, Apple, Meta a little bit. You know, Apple and Amazon and Google were the real big leaders. We had Amazon on our list today for a long, on a pullback into the $95 area, and even with that, I did not expect this thing to be able to get back above $100 today. What a huge move in Amazon. Amazon at 4% today. It's such a big move for this stock. $100 is a little bit of an area for this thing. Just look at this 5-minute chart, just a complete and utter monster. You know, Google back above $100 as well. It's so funny that these things trade at the same price. So both of those had breakouts. They're both the strongest names that were out there. You got really good volume on Google today that helps to confirm the move. Amazon also a pickup in volume that's confirming the move. They're a bit extended at this point. I actually at one point today, because I really like this exercise that we do for the SPYs, Qs, and Russell, where we've kind of figured out the sweet spot of extension away from the ADMA where it struggles to continue. And I spent some time today just looking back at Amazon, both Amazon and Google, in kind of recent history since it's been in this, you know, $100 area range, you know, anywhere from, you know, mid-80s to 110 or so, about on the bigger moves, just how far extended from the ADMA Amazon and Google get. And I was doing that as an exercise for myself because I wanted to size down a little bit. I'm still pretty heavy in Amazon, and it's been a phenomenal 4-day move. So I wanted to size down in Amazon a little bit, but I didn't want to kind of be too early on that and you know, mitigate profit potential. So I was really looking back to try to see on Amazon, Google, you know, how much extension is too much for these things, at least in recent memory. And it's usually when it looks like when this thing at a max will get to like $5 to $6 extended away from the ADMA, and then it struggles. And we're right there right now. Amazon is $5 extended from the ADMA. But not only, and I do try to keep this in mind also, you know, I'm always thinking about extension from the ADMA, but you also want to think about, sometimes we get these scenarios, it doesn't happen as often, But sometimes we get these scenarios, we've seen it with the market too, where we go from extended to the downside to extended to the upside in a very, very short period of time. And I think sometimes when that happens, that move that's so big from extension to the downside to extension to the upside means that you don't need to get quite as much extension from the ADMA as you typically do to get the kind of snapback a little bit or to get the rest. So now, I'm looking at Amazon. It's not only $5 extended, which seems to be where it tends to struggle, but this thing just went over the course of 4 trading sessions from almost $5 extended to the downside, which is again usually that max stretch of the band, to the upside in just 4 days. And that's a sick move. And that's even what I was thinking initially when I started to put this TQQQ hedge on today. I'm looking at it, and I feel I'm nervous about my TQQQ. Look, it's a hedge. I'm net long. If the market goes up, I'm going to make money. But I treat hedges like trades. That's what benefits me. I recognize also that it is a hedge, so it enables me to maybe give it a little bit more risk and a little bit more space than I'm otherwise potentially comfortable with. But I'm nervous about this TQQQ short because the Qs are almost $10 extended, but they're not. So potentially started that a little bit early, and there's no confirmation of extension really from SPYs and IWM at this point. So I might be a little bit early on putting that trade on, so I'm gonna be pretty conservative. But the other thing that I was thinking about was, not just that we're almost $10 extended to the upside, or that we're $9 extended to the upside on the Qs, but that we were just 4 trading sessions ago $8 extended to the downside at lows. It's just a massive move in 4 days to be able to go from that spot to that spot in such a short period of time. But at the same time, I'm looking at this option flow, and I'm like, oh my god, like, do I really want to be fighting this right now? So I got the trade on. I'm nervous about it. It is a hedge. It's not the end of the world if the market continues to go up, and I'm gonna try to have a somewhat conservative game plan with it. But it's really such a unique market, and sometimes I love to take a half step back, because this is what I love about markets. This is what I love about the business that we're in, is the puzzle that we're in. It's constantly changing, and I think you could be in this business for 50 years. I haven't been in the business that long, but I think you could be in this business for 50 years and still see a lot of really unique kind of technical situations happen because of various news events or whatever the situation and the new normal of that market is, and that's just one of the things I love. So obviously I'm here to position myself and make money, and again, outside of that SIVB loss that I'm probably going to be taking, I'm having like a phenomenal start to the year. I've been very, very happy with my trading, and I think that as a team we've been doing really, really well with our communication and our call outs. Our thought process has been consistently excellent. But I like to take a half step back sometimes and just look at this market and be like, wow, it's really interesting. It's like just a really interesting environment. Like how is this going to play out? What are we looking at for the Fed on Wednesday next week as far as increases go, and what does that mean for the market, and how is that going to eventually satisfy the differences between mega cap tech companies represented by the Qs in a lot of ways, and your more mid cap, small cap companies that are represented by the IWM? Because I don't know how it resolves itself, but I don't think that these differences, these extreme differences, can continue to last for a very significant period of time. With that said, we always want to remember that a market can remain irrational for longer than you can remain solvent, and that's why we want to be careful on certain things, like with our banks. And let's take a quick look at those banks. XLF had a big snapback today. We've been looking for this move. I started buying Bank of America yesterday. I started buying JP Morgan today. JP Morgan actually made new post banking crisis of 2023 lows today, even though this was the strongest one initially in the pullback. Bank of America kind of took over a little bit of strength, but I kind of viewed that as an opportunity to be able to get in some stock on this JP Morgan. Really, I'm just looking for snapbacks to equilibrium on this, which is not a very greedy game plan. If I was greedy, I should be looking for new highs on these names based on my actual thought process, which is my thought process is that the big banks are going to come out even stronger than ever off of this. So like with that thought process and the thought process that in 2 days Bank of America saw $15 billion in deposit inflows, well then I should probably be holding Bank of America for a move to 37 plus and JP Morgan for a move to 145 plus. But I'm not. I'm really I do like these names right now. I do like these banks. I'm really just looking for snapbacks to equilibrium. So maybe mid 130s for JP Morgan on a real snapback, maybe 31-ish for Bank of America, and then maybe it's worth it to hold a runner to see if you can get that bigger move. But they are counter trend trades. So that's that. That was kind of my newer trade. I got lucky with Snap after hours with the TikTok news that came out. That gave a nice trade. I re-entered that this morning, and then I exited it into the close. So that made me a few bucks. I liquidated my pins position today into this big move. I looked to rebuy a dip. I wanted to get back into Roku. It did not quite get filled on the bid at lows. It's unfortunate. I wanted to get into not Snap. I wanted to get into Shop, but I didn't get filled on the bid by literally 1 penny to initiate a new position at lows and Shop today. And this thing closed phenomenally well and actually broke out above 44 bucks today. Did not aggressively trade Amazon or Google or Apple today, but I've been swinging them, so I just continued to get paid based on doing a good job on other days. So that's always nice. And I think my biggest frustration right now is that this PDD that I'm short has been significantly stronger than my JD that I'm long, as kind of a little bit of a pairs trade there between those two companies that I have going on. But it's on a thesis where I like JD as a company and hate PDD as a company. I don't understand this PDD. There's a serious issue that there's a couple serious issues that this company is facing right here. Not the least of which is that they run a massive company, on that Temu, which basically is just a website for what's the word that I'm looking for? Not stolen goods, counterfeit goods. You just counterfeit everything. But cool. So that is, I think, all I've got on my end, and it was a good day. I'm happy to answer any questions you guys have. So let's see here on the VTF what I missed. From J. Cole, maybe bank concerns settle down and they rotate back out of tech. Yeah, more of my thought process that I was looking for today, similar but different, was not necessarily that they rotate out of tech, not which I think would imply that tech goes down, more that tech takes a break. Where the bank concerns settle down, tech doesn't pull back, it takes a break, and this IWM and XLF and stuff have much bigger percentage moves on the upside. That was actually more of my thought process today, and it didn't happen. Everything was up massive, but it was still tech that was up the most, and the option flow was just insane. But we'll see. Sometimes I'm right, but my thought process is early, and sometimes I'm wrong. So we'll see how that all plays out. Yeah, stochastics and Bollinger Bands, you can look at that. I know Pat looks at Bollinger Bands a lot. Sometimes I'll just ask him for a view towards them. I don't use them. I don't like having too many indicators, oscillators, etc. on my charts. And I find that traders can easily become overly dependent on them. I think that you want to learn to use indicators properly, and that the way to use indicators properly is to utilize them as an extra layer of probability. I don't think that you should ever trade purely off of an indicator, or Bollinger Bands, or RSI, or Ichimoto clouds, or doji sandwiches, or whatever it is. But and I even actually chatted with a trader today about AMD at one point, about a short. Trying to remember what time. I think that was right here at about 10 a.m. or so. I was thinking about shorting AMD at 10 a.m. this morning because it's just it's the strongest name out there, so you got to be careful. It's like a day 3, day 4. The extension on AMD to the upside here is getting ridiculous. This 3-day move is just sick. And at one point today, when this thing was approaching $93, it's now 10 a.m. and it's very extended on the 5-minute chart, let alone the 15-minute chart. So my thought process is, sure, it's relatively strong, but I'm just looking at this thing. It feels like it's starting to exhaust. The volume is increasing. It's extended on the 5-minute, let alone the 15. It's also extended on the daily chart. Maybe I should put a short on. So I was thinking that. And then I messaged Pat while I was on the radio, or maybe I just asked him. And I just asked him where the RSI was on the 5-minute, because I know that that's one of the things, one of the layers of probability that Pat likes to look at on his counter trend trades. And Pat, in some ways, is a better trader than me. And in one of those ways is that, even though he's younger than me, so shout out to Pat, because I feel like this is one of the trading attributes that actually really comes with age, is patience. I'm a much more patient trader now than I was, when I was like in my 20s and even early 30s. When I was younger, I'm much more patient now. That's a hard attribute, I think, to kind of develop. And a big shout out to Pat, who is a relatively young guy, despite his voice being so handsome, about just how impressively patient he's able to be on his trades. And he recognizes, like I do, and like I always say, when you're looking at these counter trend type setups, you're thinking about shorting AMD, which is the strongest stock on the market, which I was thinking about doing at 10 a.m. today. You're better off missing the trade entirely than being too early. I really think that that's a key rule. And that's also why I'm a little bit nervous about my TQQQ short right now, because I think I'm too early. But you tend to be better off than missing the trade than being too early, because if you're too early, a lot of times you can end up being right, but you endure so much pain that you end up not even making any real money on the trade, because you're having to average into it, or you're getting stopped out and re-entering, and it's just very difficult. So I think when it comes to counter trend stuff, a great rule, first of all, trading with trend is easier than trading counter trend. I've been saying that for years. I still think it's very much true. Trading counter trend can be profitable, but you've got to be really patient, really know your setup, really make sure that you're managing your risk. And I think that the key rule there is that you're better off missing the short than being too early. Because if you miss it and it goes down, whatever, there's going to be more trading opportunities in the market. If you're too early and it continues to rip in your face and you don't manage your risk properly, you can get really hurt. Or even if you do manage your risk properly, you might really struggle before you capture this thing. And with this AMD, I mean, I don't see how in any way I could have shorted this thing around $93 today when I was thinking about shorting it and come out of it profitable. There's no way. No matter how small I was there, this thing was just too strong. Continues up to $97. So anyway, and Noah's question, not even question, Noah's information is what kicked off this whole tangent. How to properly utilize other tools that are in trading, like stochastics, Bollinger Bands, RSI, Ichimoto Clip, pick your whatever. And the way to do it is as an added layer of probability. It's when you've got everything else and then those things are confirming that you go for it. So I'm looking at AMD and I'm like, wow, I've got a little 5-minute doji that kind of came in here. I've got massive extension on the 5-minute. I've got the right time of day. It's becoming, post 10 a.m. where keeping extension on a 5-minute chart becomes very difficult. Shortly after that, keeping an extension on a 15-minute chart tends to become very difficult. So I got the time of day on my side to try to go counter trend. I got extension on the daily. I got extension on the 5-minute. I've got volume that's increasing more or less on the way up. This all looks good for me. Yes, I'd be fighting relative strength. Yes, this market's acting kind of strong as well, and tech has shown some leadership. And I was like, Pat, where's that RSI on the 5-minute? And he was like, it's not cooked yet. This thing is saying that this thing could still give a little bit more momentum and continue. And that was all I needed. That extra piece of information from Pat, that extra layer of probability that said, yeah, you got this relative strength here that's against you, and that RSI is not confirming your trade yet. And I just looked at it, and I was like, do I really want to fight the strongest stock in the market by shorting here when I don't have, full kind of confirmation? And the answer was no. So I didn't take the trade. And again, utilizing the team here and asking Pat for some information, in this case, saved me some money. Because otherwise I was ready to hit the short button here, and I would have lost money on it, and instead I never got involved. So anyway, tangent there, but appreciate the information, Noah, and you caused it. Next is from Kyle. A few questions. So yesterday I tried XLF off the open and I got stopped. Bank of America had relative strength as a layer of probability, unlike XLF, and so I should have chosen Bank of America. Before the open, you had mentioned to give a stop to a pre-market low. However, I did not get in until near the end of the first 5-minute candle when it broke 31.40. So this is yesterday, right? Okay, when it broke 31.40, and then I gave myself to lose. I'm fine with that. Should my stop have been the pre-market? No, I'm fine with using the lows, especially with how that first candle formed. Or had enough time gone by where low day was correct. Yep, I think it's fine. Also, if I had chosen Bank of America, should my stop have been the pre-market low? It kind of depends on your trade, you know. So first of all, a couple things. You're comparing potentially buying the index versus buying the stock. I think that's two different things. I think if you were looking at buying like Bank of America versus JP Morgan, you want to try to go with where the relative strength is, which sometimes can be a little bit tricky to read because you can have different readings on relative strength and relative weakness depending on the time frame that you're looking at. Like if you're looking at a daily chart, you could make an argument that JP Morgan is stronger. If you were looking at the small time frame over the course of the last 2 trading sessions, then you'd be making the argument that Bank of America is stronger. So that's got a little bit of give and take to it as well. But I think if you're looking at the index or the sector ETF in this case versus an individual stock, I think that's different. I don't think you're really looking at, you still look at Bank of America for relative strength or JP Morgan for relative strength, and you can compare that versus the XLF just to give you a broad understanding of if this is one of the stronger or weaker banks that are in that sector ETF. But I think if you're choosing to trade XLF versus you're choosing to trade Bank of America, it's kind of like if you're choosing to take individual stock risk or not. Do I just want to have the entire sector because I really like financials and I don't know which is the best one? Or do I want to be involved in Bank of America because Bank of America, and this, by the way, is one of the reasons why I liked Bank of America over XLF yesterday, because Bank of America had news hit this morning where we had $15 billion of deposits hit the stock. So I think that's how you more want to think about the relative strength and kind of weakness there. And then everything else in your question I think I answered. So question number 2, as you know, I was involved in Path today. I did not really like my entry. I didn't love your entry either. And so reviewing, I didn't hate it though either. And so reviewing different ways I could have entered, was the 10-20 inside 5 a way to get in? So the trade here is you have an earnings name, and a lot of the times we like, pullbacks or time corrections or price corrections to the ADMA on the 5-minute for that first touch for a pivot low to come in that can be tradable. My issue with Path, and it might just be because I know the company so well because I trade it every day, my issue with Path was I didn't believe it was going to be able to bounce to new highs. I'm trying to wrap my finger around why I believe that. Because there's no real indication. Like, sure, it broke opening lows. If you have a momentum move off the open, which this had, and you break opening lows, you have a very low probability of seeing new highs come in on the day. And that is actually an accurate statement for Path, and it played out that way. At the same time, that statement of an opening momentum move where you break the opening low, when the ADMA hasn't caught up and when you're dealing with an earnings name, I think is actually very different. I think there's a higher probability that in an earnings name you could get new highs on the day. $18 is major daily resistance though, and you're talking about a lot of upside extension on the daily chart at this point because the stock gap 20% up on earnings. So I think that was more my issue, was kind of the daily chart, and that's why I didn't love the idea of this pullback. The other thing I didn't love about is actually that it had the opening move. A lot of times I prefer when they either go sideways or sell off kind of right away into that ADMA, but it's a really strong earnings report. They just gapped it up too big, and then you get that strong pivot that comes in at the ADMA for continuation. So there was a few things, and I'm sorry I probably didn't do as good of a job communicating that to you in real time. There are a few things that I didn't love about the rebuy there, and that's probably what it was. And I was nervous that seeing new highs in this name would be low probability, and I was also nervous that you would actually maybe get a bounce, but then that bounce would actually lead to a failure to new lows, and that actually never happened. But I actually thought it might at 10:15 here. Fine. This weak attempt of a bounce off the ADMA on the 5-minute on that first test where it barely ticks above 17, and then you get this 10:15 candle that comes in that's very weak. I'm actually surprised lows didn't break there. But to more directly answer your question about is the inside 5 a better way to get in, generally for this type of trade, which I just explained why I don't think that this path one was the ideal situation for it, generally for this type of trade, I like the first touch of the moving average if there's a signal with it. I actually don't like this one as much because it's the second touch. To me, this almost looks like I just said, off this 10:15 candle, to me this almost looks like it wants to make a lower high and fail. And I'm sure the market was probably a little bit supportive as well at this point with the name. And I don't hate the idea of an inside 5 and up because you're waiting for confirmation. So you're having, this bad candle comes in at 10:15, but then you get the inside 5, and then that inside 5 breaks up. So you're getting confirmation this can go. So I don't hate it, but I would just say very generally that I prefer the first test as a general rule for this type of trade. And secondly, I had specific reasons why I didn't like this one in particular, but it worked. So I hope you made money. Worked its way up to 1750 or so on that. I think I had a sale here myself at 1749, right above those highs. So good trade. Glad you made money on it. Number 3. I see Robert listening in on the YouTube. Robert, I think Kyle here might be the new you. I don't say that in a disparaging way. Robert used to be like the 20 question per afternoon meeting guy, and now you're stepping up in his stead because Robert's learned everything I can teach him. But again, I don't say that in a disparaging way. I really, really appreciate the questions. I think they help both you and everybody else in the VTF, so keep it up. So anyway, missed PCT off the open. I don't know what this PCT is. Pure Cycle Technologies earnings, I'm assuming, but I must have missed it. I don't know what this is at all. Missed it off the open, as the only real level I noted was $6 as previous daily support. Let's take a look at the daily. $6 you had support. I tried to support it back here in February. Then it kind of acted even as a little bit of resistance. So you can see $6 is an important inflection area. I don't know what's going on with this stock, but I can tell you as a general rule, I'm not going to want to buy a $6 stock after a 43-cent move and take on 44 cents plus slippage of risk to buy it through the level despite the momentum that's coming from it. But let me read the rest of your question. Would 540 have been a trigger level to use off the open? Opened right at it, which is the 3.9 daily red Maribozu high. I do love the negation of a good negative Maribozu, especially if that negative Maribozu is on high volume, which this one is not. A lot of times when you can negate that candle, it means that every single seller on this candle is making a mistake, so it leads to a lot more buying. But this one's not really confirmed by high volume, so I don't know. Maybe. It feels like it's forcing it a little bit, the 540. Sometimes I do force it. Sometimes forcing it works. Sometimes it doesn't. Just want to make sure when I go back and study this that I am playing off. Yeah, no, I think the thought process with $6 was correct. Again, I really don't know this name too well, so I don't feel like I've got strong conviction on my feedback for you on this one. But broadly, I think $6 looks like an important area. Obviously, earnings or something was going on here, and I'm not chasing 45 cents worth of risk. From feeling bullish, apologies, I'm a little late. Just curious on the short QQQ on the daily Maribozu. Sure, so I'm assuming that the question is, why would I be going home short T-triple-Q when I've got a positive Maribozu in the Qs, which is such a bullish candle? That's a great question to ask, and so I chatted about it a little bit. Maybe you weren't here yet. It's because of the extension. And what I'm saying, and I'll repeat it, is that I think I'm too early on the trade. I think I jumped the gun on the trade. I probably should be patient and be waiting for tomorrow. And same thing, like I just said before, with the small time frame with the AMD trade. Sorry, I got distracted by something. Like I said, on the small time frame with the AMD trade, you're better off missing counter trend trades than being too early on them. I really think that that's a great rule. Yet here I am in TQQQ and I'm possibly being too early. Part of my thought process, so really just my thought process is that QQQ is almost $10 extended. And it's whenever we get to $10 plus extended with Qs and SPYs when we typically struggle to continue. Doesn't mean that we can't continue. Doesn't mean that there haven't been instances of $12, $13, $14 of extension from the ADMA on some of these indices, especially more on the downside than on the upside. But it could happen on the upside as well. But what I was saying earlier was it's not just that this is approaching $10 of extension. Sometimes what I pay attention to, even though this is a little bit rarer of a situation, is going from downside extension to upside extension. Because it's not just that this is, $9 extended as of the close. It's that it was $8 extended the downside 4 days ago. So think about how massive of a move that is. Qs just went from 285 to 307 in 4 trading sessions. So yeah, I'm not quite at the $10 of extension. I may be jumping the gun here, but I was thinking about where it was coming from. I am also thinking about in my brain the fact that I do have longs on. So even though, like I said earlier, I don't take There was a time in my career when I was trying to learn how I wanted to hedge in markets, and this is a lot of times how you become a better trader, I guess, over time, is you learn what works for you and you learn what doesn't work for you. And there was a time, however many years ago, maybe 5 years ago at this point, where if I'd have a bunch of long swings on and I was nervous about the market for whatever reason, I would short Qs or short SPYs, and I would have no stop loss with it, because I'd be like, it's a hedge, I'm short SPY. I want to be short SPYs and Qs because my long positions just went up a lot, and I'm nervous about the market. And all that would happen was I would just bleed out money on those shorts. I didn't have a proper game plan on where would I get out of them to stop bleeding out my profit on my longs if it was going against me. Maybe a little bit of a better game plan on where I would get out of them if the hedges, if you will, came down. But it just didn't work for me. So what I've learned to do for myself is I take them as trades. So this is an actual trade for me, this TQQQ. It also happens to be acting as a hedge. So I keep that in mind when I'm thinking about what the game plan for the trade will be, as far as how much I want to risk, how aggressive I want to be, how much space I want to give it. But I keep them as trades. So at a certain point, I would stop myself out on the upside. At a certain point, I'll book profit on the downside. I have like a bunch more specific game plan for how I'm approaching that trade, while keeping in mind that I am able to offset losses on that by the fact that I am still net long at this point. But I'm nervous. I'm nervous that I'm starting too early on that TQQQ, because the SPYs and the IWM are not confirmed that upside extension. Hell, the IWM is not even at the ADMA on the daily chart yet. And the other thing that really has me concerned is the degree of bullish option flow we saw from mega cap tech stocks today that really could lead to continuation tomorrow. So I'm keeping a pretty tight leash on this one, and I'm not too heavy. From Anthony, as a newer trader, when is it appropriate to start considering pre- and aftermarket trades as swings for overnight or longer? Also in those trades, that kind of sounds like you're talking about two different things. Also in those trades, how do you set your risk reward, knowing that the spreads are wider, say on an overnight versus a long swing as opposed to a day trade? Okay, so let's tackle one portion of this question at a time. Pre- and post-market trading is very dangerous. It's much more dangerous than intraday trading. You really need to make sure that you know what you're doing. You need to be aware that a lot of routing does not work pre- and post-market. If you try to market buy or market sell pre and post market, nothing will happen. Market buys and market sells, and the word market's literally in it, only work when the market's open. If your stop loss is routed to a market buy or market sell, which most of us are, and you think you can put a stop loss in pre or post market, and then your stock goes down to where you think your stop loss is, it's not going to trigger. It's not going to get you out of the position because market orders don't work. Stops don't work. So the only way that you can really trade pre and post market is using limit orders, which doesn't mean that you have to always provide liquidity. You can take liquidity, but you got to be able to cross the offer and hit the bid with limit orders in order to be able to do that. If I've lost you anywhere so far in anything I've said, it means you're not ready to trade pre and post market. Next is that you've got to be very careful about your liquidity. You got to be very careful about your liquidity. You want to trade SPYs pre-market, Qs pre-market, Apple pre-market, fine. There's plenty of liquidity in those things, starting very early. Plenty of other stocks, there's zero prints going off, there's no liquidity, there's a massive spread, and you start thinking you can buy or sell these things because of whatever thought process is going through your head. You can do a lot of damage to yourself. I'll never forget when I first started my trading desk, when my trading desk was new. Might have been like 2014 or something like that, getting a panicked call at like 7:15 p.m. from a trader who was still on the desk, and he did it by accident, so I felt really bad. There was this stock, PCP, Precision Cast Parts, that eventually got bought out by Berkshire. It was a very, very thin stock, and we used to trade it sometimes. And I guess he had it up on a market maker, and he somehow bought the stock at like 7 p.m. But the spread was like 8% or something like that. And he somehow crossed the market. And he called me almost like crying. So if, and this is another one of these BS things. If a trade goes off that is more than 10% away from the last print, you can get the trade broken. But the robots know that. So on these really, really, really spready names that have no liquidity, they'll have the after-hours spread be 9.5% away from the last print, because they know if someone actually accidentally fat fingers, like this person did, the trade can't be broken. And then on top of that, not only did he cross the spread and hurt himself, he panicked and crossed the spread back in the other direction to liquidate the position. And then called me, as a newer, smaller trader with a nice little, like $8,000 loss or something like that on the trade. Super, super, super upset. I felt really bad, but there was nothing I could do. So that's probably more of a story about being very careful about, your hotkeys, and if you're eating lunch at your desk like I usually do, make sure that you don't, drop your sandwich on your market buy button, especially at 7:15 p.m. with PCP, which again no longer exists, or Chipotle or some craziness on your market maker. But it's also a warning about how wide spreads can get when the market is actually closed. So you got to be careful about all that. A lot of what I do pre and post market, and it's more pre-market than post-market, a lot of what I do pre-market is management of positions that I'm already in. So if I have a specific game plan that's a swing position, and that game plan says I'm supposed to buy at a certain price, I don't care if it's 5 o'clock in the morning or if it's during market hours. I'm supposed to buy at this price because of my game plan, and I'm buying at that price. I don't do as much new stuff early. I will sometimes, but it's usually going to be a small feeler, and then I will wait for the market to be open in order to get heavier. And the other times when I will trade more actively is after earnings. Earnings report just hit in Apple. Stock is super liquid. Very regular. I mean, just 2 days ago, I traded S until almost 8 p.m. Eastern because the thing was moving. I had a game plan. I was making money, and it was working out well for me. But it's the same thing. If you're trading anything, if you're trading an earnings name after hours, you dang well better know what you're doing, because if you better be able to get out of your positions, if things are going against you. I have gotten stuck. I got stuck in Facebook once years ago on a massive sell-off it had on the earnings report. It was down huge already, and I went long, and then Zuckerberg said something on the conference call that the market hated, and the whole thing just spread away from me so fast I wasn't able to get out, and I took a really big loss trading after hours. With that said, most of the time I do really well trading earnings names after hours because the tape trade's very pure. So that's that. Swing trades, I feel more comfortable. Newer traders getting involved in earlier, but I've got specific rules for that I really recommend that people utilize. The thing about taking overnight risk is that it is a big risk. You never know how the market's going to gap the next day, especially this market environment that we're in right now. The whole market could gap down 2% tomorrow without a problem. So one of the rules that I have is this 1% rule or 1% guideline, and I've always called it the 1% rule. I'm going to change that officially as of today to the 1% guideline. And the reason I'm doing it is because 1% is not enough a lot, and it's particularly not been enough in this market environment because the market gap's so big. So when do you want to swing a position overnight? You want to do it from a position of strength. You want to do it from when you're in a win-win situation. If you bought the stock today and the stock went up big and you're good in the money and you booked, you sold 60 to 75% of the position intraday and it's 4% in the money in your favor and the daily chart looks fantastic, keep it overnight. Keep it. Try to get a bigger daily chart move. That's reward maximization. What's the worst thing that happens? The stock goes back down a whole 4% and you get stopped out at your original stop loss and you still made money in the trade because you had already booked profit on 60 to 75% of your position. You're in a win-win situation. What you should not do is the stock is against you and you keep it overnight hoping and praying to the trading gods that it gets back to your entry price so you can get out without a loss. That's called unlimited risk for zero reward. That's what a lot of retail money does. They buy the stock, it goes against them, they hope and pray it can get back to their price so that they can sell it without a loss. Unlimited risk for zero reward. It's the opposite of what a professional trader should do. But you want to have a profit cushion because, again, let's say that you're 0.5% in the money and you're like, I'm going to keep this. I think the daily chart looks good. I'm 0.5% in the money. But the whole market gap's down 2%, or God forbid your stock has bad news. Next morning you wake up, you're in a really bad spot. It's gapping down past your stop loss. You never want to be in that spot. So I say swing, even as a new trader. Go ahead, swing some positions, but do it from a position of strength. Do it from a win-win. Make sure that you are at least 1% in the money. And for certain high beta stocks, certain markets that are very volatile, like right now, 1% may not even be enough to keep the position overnight. But if you've got that good profit cushion, the flip side of it is reward maximization. And this is what I talk about all the time when it comes to reward maximization, is that, and one of the examples I loved using was this day back here on January 6th. We were eyeballing this consolidation in the market that was going on for weeks to see which way it would break. This is the breakout day. If you got stock on January 6th, the market closed well, it confirms the breakout, you swing that, you're easily still in that. Maybe you bought stock at, whatever your stock is, SPY equivalent of, 384, 385, a really tight risk trade on the 5-minute, it closes really well, you keep some overnight, next thing you know, you're getting a move to, SPY equivalent 418. It's all extra money that's going in your pockets. It's a win-win. You trail it on the daily chart. Eventually, you get stopped out. You give back some, but eventually you get stopped out on the way down, and you catch a move and a risk-reward ratio bigger than you ever thought was possible in the trade. And that's why I always talk about, everyone in the trading business loves to talk about what their risk-reward ratio should look like. 3 to 1, 5 to 1, 10 to 1, whatever. Or I guess that would be reward to risk. My thought process has always been, I want unlimited reward for my risk. I want infinite reward for my risk, which obviously is a theoretical statement, but the fact of the matter is you never know when you catch some of these moves just how big that move can be in your favor over time. If you have a good game plan in place for reward maximization, you're willing to let your winners run. And at the end of the day, that's what makes you make money in this business. Because if you can catch really big moves, ideally on decent size, that's how you make real big money in this business. Where, you know, some of those handful of trades where you catch that massive move or periods of time, it makes your year. I mean, so I'm you know, I've mentioned, I'm always really honest with you guys, right? I'm honest when I don't trade well. I'm honest when I trade well. I'm honest with my mistakes. I'm honest about everything. I could care less at this point. If I'm in a trading slump, I'll tell you. If I'm trading great, I'll tell you. And fact of the matter is, in the calendar year 2023, so far, outside of the fact that I'm stuck in this SIVB that's probably going to be a six-figure loss for me, I have been trading phenomenally well. 2022 was a much more difficult year for me. I had periods of time where I was really treading water or giving back some profit, but I had a few key moments throughout the calendar year where I maximized my reward, I timed my entries properly and maximized my reward that made my entire year. You know, catching the March rally was a really big one for me. And then capturing the summer rally was the second big one. We caught both of these as a team from a communication perspective and with my own trading, like literally perfectly, the entire move on size from bottom to top on both of those. And then finally was actually the October move off that low. And if you guys remember, you know, pre-market, the low is 348. Pre-market was even below that, and we were getting stock. That's actually pretty cool now I think about it. I don't know if I've ever done that before. In the calendar year 2022, I was able to buy stock below the low of the year. That's kind of cool. But outside of those 3 periods of time, I struggled a little bit last year. I've always been better to the long side of the market than I have been to the short side of the market. I've been working on improvement. That's probably the result of trading a 10-year bull market before coming into this bear market. But it was the fact that I was able to catch a few key moves on size with good execution and really hold for reward maximization that made what would have otherwise been a pretty difficult year for me into something that, you know, was a little more decent. So yeah, big answer to your question, Anthony. I really hope that helps. Next on here is from Brian on ExxonMobil. Regarding the back through $100 setup today in Exxon, it went through $100 a few times. Curious about a good approach. Buy first time small size with multiple dollar risk. Buy first time larger size, tighter risk. Get stopped, try again. Next time same risk. Try once, then leave one stop. Cool. So I don't know if you stayed on the VTF after the morning meeting, because I know you had a few other things going on because we spoke so recently. When this got to $100 at 9:55 a.m., I don't know if you're in the radio, but I was specifically saying that we should not buy it here. You know, so a lot of, and I was going to make this point earlier based on something that somebody else said. You know, when we're doing the morning meeting, we do the best we can with what we have, right? Which is we can't see what any intraday chart looks like for the day because the day hasn't started. All we know at that point is the daily chart. So I come up with a thought process based off of daily charts in the morning meeting, based on how things are gapping, based on degrees of extension, based on levels that we're able to find. And then that thought process adjusts as the day actually opens. So I remember in the morning meeting today, you know, I talked again about this concept where it's been interesting because I really have not liked the XLE, but I like a lot of the stocks that are in it. I like Chevron a lot, which we communicated as a potential long today. I like Oxy a lot, which we communicated as a potential long today through 58, you know, with Warren Buffett buying more yesterday. You had mentioned this ExxonMobil. Took a look at this ExxonMobil. Very extended on the daily chart. It's also an energy name that I kind of like. Pretty strong, has a lot of cash flow, dividend buyback, etc. $100 is a little bit of a psychological level. I don't think it's a real level besides that. I have no idea what's going on. This must be a fake candle here on the 24th. But this degree of extension, I'm like, okay, maybe this is a long back through 100. The idea here is that in these bearish markets, you know, one thing about going counter trend, meaning that the market's bearish and you're going long or the market's bullish and you're going short, is that even when you're trading counter trend, you still want to trade in the direction of the market movement. that always makes trading and execution easier. So if I'm looking at pre-market ExxonMobil, I don't remember what price it was trading pre-market, but let's just say it's $99. What I generally don't want to be doing is just it's going straight down and I'm just catching a falling knife and having bids out and hoping that it bounces back. Generally, I want confirmation that it's already on the way back up. So we have a bunch of different strategies where we utilize that. One is called this RDR or DOO, Derrick Oldensmith overthrow kind of strategy, where on like a day 3, day 4, or day 5 down, we will buy back through the previous day's low versus today's low as a stop loss. But the whole idea again is that you're buying it on the way up. If it never gets back through the previous day's low because it's trading down all day, you never enter the position. It's kind of no harm, no foul. So when I'm looking at some of these weaker energy names right now, they're certainly in an area where they're extended enough where we can start to look for the opposite side of the trade to come in. But I'm asking myself when I'm looking at this thing pre-market, all right, where is a good spot for me to be able to actually buy this where I know that I'm buying it on the way up and I can buy it through a level versus a level? And the thought process at that time for me was $100. Yesterday's low is $100.22, so maybe you could use that. $100 is a little bit of a psychological level. Let's keep an eye on this thing at $100 on the way out. When the market opened, and again, I don't know if you were still tuning into the VTF when I was on the radio. When the market opened, I know Sharir was buying up Chevron very early, caught a great move on that. He was booking profit into 10 a.m. I think a couple people said that they were involved in Oxy. Oxy was great, relatively strong off the Warren Buffett move. ExxonMobil, $100 was the spot. Didn't seem like anybody was in it. By the time 10 a.m. actually came around and the stock was approaching $100, I really did not like the buy there because the small time frame was not confirming it. And if anything, the small time frame was in a spot where I actually was expecting that the stock might pivot back down. There was a reason why at 10 a.m. Sharir was communicating to the team that he was booking his profit, and he might have even liquidated Chevron entirely into 10 a.m. And it's because he got this full move, almost a gap fill, into this equilibrium zone, the space between the 8 and 21 EMA. That's really all, as a general rule, you can expect on your counter trend trades is for a snapback into the equilibrium area. And then you want to measure what equilibrium is on multiple time frames. You know, maybe this, because the daily chart extension can become a higher low where you can buy the next dip down, find that higher low for the next move, or maybe you just keep some stock, book some profit into this equilibrium area because this is where you expect it to pivot back down. But you can keep some stock versus the original low to look for a higher low, higher high that leads to the bigger move on the actual daily chart. So the problem at 10 a.m. when Exxon was getting to $100, it was getting to a spot on the 5-minute chart where this is telling me that this thing should actually pivot back down. So I actually literally typed this stock up at 10 a.m. because I remember that I said in the morning meeting that this could be a buy at $100, and I typed it up and I communicated. I was like, guys, I stay away from Exxon right now. I really don't like the buy right here. I think it's gonna actually pivot back down. So hopefully no one bought it here and no one got hurt when this thing made new lows. So the idea here again is the daily chart is the most important chart in my opinion. It's the most important chart. Everything you do should be based on the daily chart, but you use 5 and 15-minute charts to properly execute what you see on the daily. So the daily's telling me we could try to buy this, we got the extension, maybe $100 is an area. The 5-minute is telling me, no, you can't buy this right now. You gotta be patient, wait for a better entry, see if another entry comes in. So again, I'm not taking this trade. And a lot of times what ends up happening for me, and I assume this is for a lot of other traders as well, it should be, I will oftentimes, in the last few days I've had a pretty small list, but sometimes I'll have a list of 10 to 20 potential trades that I'm interested in. I might only take like 3 of them because so many of them, I just don't have all of the appropriate layers of probability confirming the trade when the execution actually comes. And that would be the case with this Exxon. Pre-market, Exxon $100, sure, that looks like a reasonable spot to me. Stock is open. I don't like it here, and I don't like it here either. Why don't I like it here? Because at this point, energy is establishing itself as being relatively weak, and I don't like this time of day for a new entry for a break higher. So I can tell you for myself that if ExxonMobil was on my list for $100 today, I would have ended up taking 0 trades in it because it just never confirms things properly, and that's fine. It's fine. You know, preserving capital is a big part of this business. So to answer your question, you know, you're asking more specific about, you know, is it better to buy small and give a lot of space, buy, you know, the first time with larger size and tighter risk and rebuy, or, you know, what's the proper way to be able to do those executions? I think it's very much dependent on the actual situation, and it's very much dependent on what the small time frame execution setup looks like when you're entering. Because I do both of what you're describing. Sometimes I will, you know, buy small, give it a lot of space. It's more of a filler position. Usually when I do that, I'm doing that with the idea of trying to find a spot where I can actually get much bigger with tighter risk. Because again, like I said earlier, the big money comes from capturing big moves on big size. So, you know, having a smaller size, given a lot of space, usually doesn't lead to fantastic profitability in the long run. Sometimes it's all you can get. Sometimes you just get that feeler, and that's all you get. And you make a couple dollars, and it kind of is what it is. But ideally, I want to find a way to be able to get heavier. So sometimes I'll have that feeler. I'm giving a lot of size, a lot of space. I mean, and then I size up when things tighten up. Or sometimes I just get, you know, big right away because the execution setup is there, and I'm all over it. So, I hope that helps. Oh, boy. No problem. Let's see here. Next, I think, is from Dave. I'm starting to get a sore throat, talking too much. Market rotation question. Whenever you see market-wide events like the banking crisis this past week, do you ever think it's worth trying for either a pairs trade like long XLF, short SPY, or just more general long XLF once you see it bouncing like today? I started in XLF long, hoping for it to trade back to 36, but I don't have much experience with financial events. So I went with the ETF instead of trying to find an individual name like FRC or other similarly beaten down regionals. First of all, I'm just going to go back to what I keep saying. I'm very scared of the regionals. I know that there's been a lot of reward potential in them. For me, and it's so wild. I still can't believe this happened to me, that I got stuck in this SVB. Been in this business for so long. I've never had anything like this happen to me in my entire career in this business. It's such a crazy, crazy thing. It's not worth the risk. Look, FRC looks like, and PACW look like they've been really solid trading vehicles. It's not worth the risk for me of these names getting halted and never reopening. I say that as I'm stuck in a name that's halted and may never reopen. So I like I've said, I greatly prefer XLF and major banks right now as trading vehicles. It's just I think that they're very safe. Your question, I think, is very much dependent on the situation, in my opinion. Obviously, you know, when you have something that's affecting a sector like what we have with the banks right now, it increases ranges, it increases volatility, and all of that increases reward, you know, potential risk, you know, trading opportunity, things like that. But how you want to approach it, I think, is very dependent on the specifics of that situation and the technicals. And this is why I incorporated to my trading a more fundamental, qualitative fundamental thesis for my trading. I consider myself, if I'm talking about my trading broadly, I'll usually tell people, 85% technical analysis, 15% fundamental analysis. And for me, I am not the guy who is breaking down, balance sheets and things like that. And actually, I love having those guys on the team, by the way, because they add a lot of value and they add a skill set that I don't have. And I appreciate the people on the team who are able to do that, because your conviction and your knowledge adds to my thesis, which adds to my conviction, which adds to my trading, which adds to my profitability. So again, shout out to the team here. I love it. But I like having that qualitative fundamental thesis. I like to really take a step back and look at this banking crisis like I have with you guys and really try to dissect what I think is most likely going to happen. And guess what? I'm wrong sometimes, so don't think I'm always right. I am wrong sometimes. But that's where we turn to our technicals, because the technicals, they will confirm whether I'm right. They will show me how I manage risk. They will show me how I manage reward. So in this particular situation, my understanding of this crisis has had me really wanting to buy the dip in these major banks as well. That's why I'm long Bank of America tonight. I'm long JP Morgan tonight. Both those stocks are paying me. I'm up money on both of them. I'm keeping them overnight. I'm looking to maximize my return. I think they could have more behind them. I've explained all that. So that's really how I approach that. As far as the pairs trading concept, I don't. It's so funny that you bring that up because I kind of have a pairs trade on right now. I don't really do that. Even though I have one on right now with PDD and JD, I like really don't do that. It's kind of a coincidence where I really like JD long and I really like PDD short, and I'm also like, oh well, great. You know, if I take JD long, I've also been avoiding trading the Chinese names because I've been complaining about how the Hong Kong ADRs have led to bigger gaps. So I stopped trading them. I used to trade a lot of these Chinese names like every day, and I've really stopped trading them. But you know, again, I want to be short PDD. I really, really, really dislike the company. I think that there's a lot of fraud and BS going on at that company. It's a decent trading vehicle, and I like JD as a company a lot, and I kind of I've wanted to be long that name for a while. So it's just kind of like, well, if I'm dealing with all this gap risk from these Chinese names and the Hong Kong ADRs, what if I put on a PDD short and I trade it that way because I hate the stock, and at the same time I put on a JD long and I trade it that way because I really like the stock, and it can actually, it's kind of a pairs trade, but it's going to be helping to mitigate some of the overnight gap risk that I'm dealing with these Chinese names as I try to trade them and let the trade play out. The problem that I'm trying to figure out right now is PDD has earnings on Monday morning, and I really am this thing could be at $110 on that earnings report, so I gotta be very careful about that. And then JD won't be up that much to help hedge it. I don't like pairs trading, though, as a general rule. At one point in my career, I actually ran a gray box algorithm that was designed to pairs trade. I stopped. And if it was super profitable, I probably wouldn't have stopped. So I'll let you guys figure that out. But basically what the issue was when I was pairs trading was it was all based on statistical analysis, and I kind of had machines that were doing it, and you know, you purchase the underperformer and you short the outperformer, and you look for mean reversion on similar companies based on their historical correlation. And the issue on it was that it was very consistently profitable in a very small way, and then every once in a while a news event would have, you know, like it would be very consistently profitable. I would make money. I don't remember the numbers. I would make money like 15 out of 20 days in a month, but one of those days that would be a loss would be the loss would always be because of a news event that occurred, and that loss on that one pairs trade in that day would wipe out the entire month's worth of gains. So after about a year of doing it, I stopped. So I don't really do much on the pairs trading sides, which is why it's so unique to see me in this PDD JD kind of situation right now. Example, say a short like you did with TQQQ, thinking gap down tomorrow with a pre-market. So I really don't like, as a general rule, putting trades on into the close or after the close that you want to keep as swing trades. Just wait for tomorrow. Why take the gap risk? What's the point in taking the gap risk of shorting TQQQ right now after the close or right into the close and keeping it overnight? Maybe it's a little bit different if it's you know, also helping to hedge longs that you have on. But why take the gap risk? Just wait for tomorrow morning. And I think you're better off missing the trade than taking the gap risk. I don't like the risk reward of that. If you wanted to take TQQQ pre-market early one day, it's liquid enough where you could do that as a trade, but you know, be careful. Whew. Was not meaning to. Oh boy, this meeting is going late, guys. from Rex. Coming into today, I'm just going to try to do short answers on questions and then try to wrap it up, but I'm not going to ignore you guys entirely. Oh man, I'm hot. Coming into today's trading section, as you mentioned, the market was giving mixed signals. Short-term tactical is in the green, but also on day 4 up. The Qs were day. So short-term tactical, when we look at that, my understanding is that's actually a measure off of the S&P. So this really isn't like a day 4 up. Technically, yesterday is a down day, even though the candle itself is green. We were negative on the day yesterday. So for the SPYs, this is really just day 1 today. The Qs is different. That's day 4. But again, short-term tactical is coming off the SPYs. So piece of information there that you may not have known. But anyway, how would you approach to the market coming in flat? As you mentioned, trend trading is easier. In today's morning meeting, the market gave a little sideways at the open, so I was hands off watching the market. Stronger names like Apple, Amazon, AMD showed some relative strength, but also we're not giving any setup for you to get long, I guess. On the other hand, a weaker name such as Tesla gave an inside 5 at 10.20, 10.35. Would you still take the trade, although it's a weaker name? Potentially, if I had market conviction, you know, one of the big things that we want to assess every day is our degree of conviction in a move in the market. It is more often that you get sideways choppy days than you get trend days. And you want to try to assess that ahead of time. And if you're overly pushing things in choppy sideways days, which happen a majority of the time, it's a great way to, you know, lose money. So you got to be very tactical in your approach on, you know, what's the probability of today being a range day versus a trend day? Which way can that look like? Should I focus on the market names that are correlated to the market versus shorting trading names that are in play because they had earnings or analyst upgrades or downgrades or what have you? I didn't have strong conviction on the market this morning. Market went up massive. I had a bullish lean, so I'll give myself a little bit of credit, but the market vastly exceeded the expectations I had in the morning meeting today. You can't, you know, we're not working with a crystal ball, except Josh has a crystal ball that shows the future. But the rest of us, we're not working with crystal balls. So there's no way we can know with certainty when a move is going to happen. We just need to assess the probability of those moves occurring. My assessment was that the market was a difficult read this morning. So don't be as aggressive today. So how would I approach today if I was flat? I would have been relatively passive today. You know, probably would have found a few things to trade. I don't think I would have been going heavy risk on anything. And that's fine. And it doesn't matter if the market gave a big move, because we don't bat 100 in this game. We do a pretty good job, by the way, as a team, of knowing the big days before they're going to happen and knowing the days that are trickier before they happen. But sometimes there's a big day when you don't expect it, or you're looking for the big day and it just doesn't come, and that's all part of your morning process. So you can't be upset at yourself if you were not aggressive today to the long side and the market gave a really big move, but you had no strategical advantage in the morning to be looking to be really aggressive. There's a really cool bald eagle outside my window right now. It's so awesome. Just flying around right in front of my window. Sick. Anyway. Anthony, my Roblox trade today. My Roblox trade today, where my risk reward ended up being 1 to 20. When I went flat, would have been a good candidate to swing, if I understand it correctly. Yeah, I don't know when you exited the position, but if you had a good price on Roblox today and it was trending the way that it was, I would be, and I already know that this daily chart looks fantastic, I would be looking to swing that for sure. From Jake Cole, do you have a written list of go-to stocks you look at every morning before looking at in-play names, or it's more of a mental list, and that mental list changes and adjusts over time? I look at whatever's in play. I look at obviously whatever's in play. I look at all the mega cap tech stocks. Look at financials. I look at energy names, but that rotates. There was years when I was not looking at energy stocks at all because they were atrocious and out of play, and lately they've been in play for the last year plus, so they're really back on the list. So it rotates. But it's definitely mental. From Kyle, I've been live with T3 for 2.5 weeks, and I've learned more in here than the last year and a half of trading on my own in college. So big shout out to the team. Awesome, Kyle. Love to hear it, man. Love to hear it. What's calculus? What's a gray box? Is that a real question, or is that a gray box? So a black box is a fully automated trading system. A gray box combines automation and manual execution. So the pairs trading gray box, it could execute entirely entirely automated, but I also could come in and have it manually execute as I was watching things. I was paying for a program, that was doing the automated execution for me based on settings that I was putting in. I don't remember how much I paid, but it was some sort of monthly cost for the system. NVIDIA just got upgraded. Congratulations to Morgan Stanley. All right. On the YouTube over here, Sebastian, NVIDIA today was huge. NVIDIA massive. Yeah, I agree with you. Hard to chase, but I mean, it's beautiful breakout. Sebastian, what do you think of trying to buy Roblox today on the break of 43? So Roblox, I mentioned Roblox in the morning meeting today, actually. What I said in the morning meeting was I really like it, and you could look to build in versus yesterday's low. I didn't specifically say a momentum trade through 43, but I could be for that idea as well. And what do I think was the right stop loss if you took that trade? Oh, this looks very tricky off the open. Probably the low of the first 5-minute bar, in which case you get stopped out. So... So that's the problem, though, with these more momentum trades, especially in this market. And Pat's been saying it a lot, and he's been saying it correctly. The buy high to sell higher strategies and sell low to sell lower strategies, in other words, momentum strategies, have been very difficult recently, which will change. Maybe it changed as of today, because a lot of them worked fantastic today. But those strategies have not been a big part of the approach I've been trying to implement recently because it's just been difficult here. So I don't think I would, because the market environment's been so difficult for those types of strategies, I don't think I would have taken Roblox through 43 really as the momentum trade. I prefer that idea of building in versus a level. The only level I see is yesterday's low, which maybe is too much risk to build in versus. But the momentum trades have been very difficult in this environment recently. They have not been working well. Which is why you want to have a lot of tools in your tool belt of trades if you can. Sebastian saying also, what about looking long Exxon? Yep, we just talked about that one for a while. Robert loves Kyle. I love it. Exxon on a good head and shoulders. All right, I'll just have to believe you on it. All right, gang, it's 5:30. Meeting went long because you guys had great questions. I love the great questions. I'm always happy to stay here and do extra work if it's going to help you guys be successful. So let's do it. Have a great night, everybody. I'll see you all tomorrow.